Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. And I want to once again welcome you to a subscriber request Tuesday video. And this one's kind of very interesting for me for a couple of reasons. Number one is it is a subscriber request. But number two, we're also going to be talking about a subject which is actually a pet peeve of mine, something as, Mr. Valuation and as a really committed value investor, I get this all the time, a lot of times from cynical people. And the question is, how do well, let me say it differently. A lot of times I'll get a statement, that stock's not a value stock, it's a value trap. Okay. And, then there's a lot of cynicism about value traps. So my goal here today, the question was, how do you tell the difference between a value trap and a real true value investment? So I'm going to attempt to really show you and illustrate how you can make those distinctions here because it's very, very important. But I'm also going to talk a little bit about value investing. As a value investor, especially in an overheated market like we're in today, I think you have to be cognizant of the fact and also embrace the reality that if you're finding value in today's market, you're looking at stocks that are out of favor. Now, the real trick is, are they out of favor for reasons that are justified and realistic, or are they out of favor because of the market overreacting to something? That's where true value is, when you can find a valuable asset that's worth more than the market is currently valuing it at, and then you can buy it so that you eventually get even the natural leverage of price-earnings ratio expansion in addition to the growth. In other words, you'll participate beyond how well the business does because you bought it at a very inexpensive price. And a value trap, in contrast, is something quite different. So allow me to read a couple of things to you here, and I apologize for turning away from the camera. But the first I want to read is a quote from Marty Whitman, who was legendary portfolio manager of the Third Avenue Value Funds. And let me talk about what Marty talked about. He points out, and this is really about value now, unrealized market depreciation occurs when the market price of a publicly traded security declines. Permanent impairment of capital occurs, which now is a true value trap, when the fundamental values of a business are dissipated with the consequent long-term adverse consequences. Big distinction there. One is a temporary interruption in a great business where you're just simply taking your lead from the price. And again, as Warren Buffett so eloquently put it, unfortunately, too many people take their lead strictly from price without considering or even by ignoring the real fundamental value of the business. And I've said it over and over again, fundamentals are significantly more important than stock price movement. Stock prices are pathological liars. They can overshoot and undershoot the value of a business constantly because it is an auction and emotions get involved. Earnings determine market price in the long run, as I'll illustrate here, but emotions determine market price in the short run. And by the way, the short run can sometimes last a lot longer than we like. Now, by definition, a value trap, and I got this from the Farlex free dictionary. A value trap is a stock with a lower than usual price that appears to be a value stock, but it is not. A value trap appears to be undervalued at first glance. That's statistically speaking, if you will, but its fundamentals are unhealthy and the stock is unlikely to recover in price. One may fall into a value trap by looking only at the stock price, but not at any other financial information. And that's a very critical distinction. So let's go ahead and turn to FastGraphs, the fundamentals analyzer software tool, and let's look at some value traps first. I'm going to start by showing you some value traps, and I'm going to try to make this clear distinction about why it's a value trap, because statistically, a stock can look very, very good on paper. So let's start with Credit Suisse here. All right, and I'm going back to December 31st, 2007, where I put the red dot here. Okay, and the key here is that the stock had a PE of 8.4. And if I go down to the dividend line here, the dividend yield was 2.59%, and the payout ratio was only 22%. Statistically, all of that would have looked attractive, especially from a company that had come off of 3 or 4 year really strong growth years. You can see earnings growth, 270%, 17, 11, 28, and 20. That was prior to the minus 192% or $6.20 loss that was created during the Great Recession. Now, let me add something here. I'm going to show you when I get into value stocks, the Great Recession, the bottom of the Great Recession was a great time to be buying most stocks if they were true value stocks. Not a great time to be buying value traps, as I believe Credit Suisse clearly is, because what happened was, now the stock did recover initially coming out of the Great Recession, but because fundamentals did recover. Earnings went back to $5 a share, which was an enormous growth rate. But then we went through this long extended period of fundamental deterioration. And today, we've got a stock trading at about $9.40 that you would have bought in December of 2007 at $56, almost $57. The PE was low. The dividend yield was high, but the company cut the dividend and the fundamentals of the business continued to dissipate, as Marty Whitman talked about in the part that I shared with you before. This is what a value trap looks like. Okay, the next one I want to show is Harsco, okay, a company, environmental facility services as a sub-industry group. Once again, we see a point where the PE ratio was under 7. Okay, that means it had a very, very high earnings yield. The dividend yield at that time was about 2.8%, which would have also been attractive. And I might even point out the company did continue to raise their dividend for the next year or two and then froze it for about 5 or 6 years before the company ultimately succumbed and they cut their dividend. But once again, you see very poor long-term performance because the fundamentals collapsed. That, my friends, is a value trap. It's not, because the stock is cheap. It's because the fundamentals did not support. This stock was very expensive here, and it got extremely expensive after it rallied right after that because the fundamentals just fell out from underneath the stock. So the value of the business was falling and falling dramatically. The next one I want to show you is Pitney Bowes. Now, this was the old postage meter company. It was very popular before, I guess, the advent of email, you might say. Okay, now coming into the recession, once again, I'm looking at 12/31/2008. The PE was under 10. If I look at the dividend yield there, and I might actually have to take the price off the graph to be able to point to that spot, the dividend yield here was 5.49%, okay, at that point in time. So once again, statistically, PE under 10, dividend yield over 5%. The stock looks very, very attractive as a quote unquote value investment, if that's what you were looking at. But look what happened to performance going forward here. You would have bought the stock at $25.48 on December 31st, 2008. Yesterday, it closed at $6.90. That's a minus 73% loss. And even with dividends, now, by the way, again, the company continued to grow their dividend for a few years, but then as the business really began to collapse, they ended up slashing their dividend, they ended up slashing it again. This is a quintessential example, ladies and gentlemen, of a value trap. Very, very poor long-term performance because the value of the business was collapsing, not just the stock price. The stock price alone does not make a stock a value trap. And then last but not least, we have Canon, it was famous for their cameras. Once again, we see the similar situation. We see a PE ratio under 12. We see a dividend yield that was 3.3% that did grow for a little bit coming out of that. But over time, this business, just as headwinds of the iPhones and other cameras and so on came along, and Canon, saw their fundamentals continue to deteriorate. And so here you would have gone again through an extended period of time, from point A to point B here with a 23% loss. A little bit of dividend income would have given you a 2% return, but that's well over a decade. Very, very poor performance out of Canon because this was a true value trap. Okay, so let's make the distinction between the value trap now and a true value stock. Okay, and I'm going to start with one here that was Brinker International. Now, this one is kind of almost somewhere in between because what I want to point out here is that Brinker is you'll know them from the Chili's restaurants and some of their other restaurants that they run. It's a major restaurant company. You can see how the stock price has tracked earnings historically year after year. You can see the company's earnings have grown pretty attractively for most years. They did suffer a little bit during the Great Recession. They went through the 2001 recession without any problems. But the stock recovered and the dividends, continued to grow. And then, of course, along came COVID, and they literally were put out of business, not because the management did anything wrong, not because people weren't attracted to the business or to the restaurants anymore. None of those things really applied. What happened was we had this COVID flash crash because we had this 100-year horrible event that came out and closed these guys down. Now, once they were able to open again, the fundamentals recovered, and you can see that, that the valuation here was a PE of 15, which would be fairly valued. The value down here was a PE of 5, and this was not a value trap at this point because the earnings of the business were recovering dramatically, and this turned out to be a great time to buy the stock. And by the way, similarly, here's a case where if you'd have bought it at the bottom of the recession, the Great Recession, the company did have a couple of bad years of earnings here, but these were still very profitable years. And the point I want to really make is the earnings suggested a valuation that was significantly higher than how the market was pricing the stock. And of course, we went through this very nice run right after that where, the stock price went from $6 a share and peaked up here when it got overvalued at $61 a share. There's your classic 10-bagger over that period of time coming out of the Great Recession. Another one is Cigna. This is classically a value stock. There were times during the Great Recession, for example, when the PE got down to 5. That was tremendous value because the earnings of the company, this is a growth stock now. It's only recently started paying a dividend, but the business continued to grow and the stock price followed suit. Even though it stayed undervalued all these years, you'd have still made really good money buying it when it was undervalued. You would have averaged almost 45% a year annualized owning a value stock at that point. It was a value, it was a GARP, a growth at a reasonable price stock, if you will, because the company was growing at double-digit rates, 16%, 17%, 12%, 15, 13, et cetera. Its long-term growth rate has been 11%, and you can see that, from this, low price point here, even though the stock is undervalued again, you'd have still averaged just under 25% a year annualized owning this stock because it's been a value stock for much of the time as you look at this graph. Now, there were times when it got overvalued, but even then, when it was because of its growth characteristics, it would have made you a lot of money if you overpaid for it. Valuation matters, and it matters a lot, but it did still give you the ability to make money because, and I'm measuring it at a point when it's currently undervalued. I want to make that really clear. I believe this stock is undervalued today. It was certainly undervalued back in 08, 09, 10, 11, and so on. All right, the next one I want to show you is an interesting one, Affiliated Managers Group, because this one, again, is a little bit maybe cuspy, I'd like to call it. Or in other words, it's kind of between a value trap and not a true value investment because what happened was the company started paying dividends. We did end up with a couple of bad years. This is a niche portfolio management company, asset management and custody bank. They have some really attractive companies, but what you see is some bad years here. Earnings fell by 1%, by 2%, and by 6%. But I do want to point out at the worst of it, at December 31st, 2020, their earnings were still the second highest level of earnings they had achieved prior to the start of this collapse. In other words, the $13.36 was still higher than the $12.84. Well, they actually peaked at $14.60, then they went to $14.50, then to $14.22, and down to $13.26. But this was still a very profitable enterprise. The company wasn't bleeding red ink like I showed you some of the others. The fundamentals were weakened for a period of time, but they didn't deteriorate. Now the company's fundamentals are coming back, and you can see the stock price is moving back into alignment. So this was a stock that would have really tested the value investor in you. And by the way, it did. My son Colton owned this stock and, really lamented at how much money he was losing initially. And now he's just rejoicing at how much money he's making because he stayed true to the value investing principles, actually added more to the stock as it got cheaper. And that's what you do with value investing. As long as the fundamentals support the value, you stick with it. And then the last one I'm going to show here is Prudential, or the next to the last one I'm going to show here is Prudential, because Prudential is a financial, and there's a very interesting, aspect of these financials. You can see that Prudential traded, this is a 15 PE, this orange line, traded at 15 times earnings and grew very nicely until the financial debacle hit. then we obviously had this collapse. Now, was this a value trap or a value stock at this point? Because you can see the earnings have been cyclical since then, but they have grown. So if I shorten this, to a 15-year time frame, earnings have actually grown at over 11% a year, and the stock has, followed the earnings growth, if you will. It's very inexpensive today, but the earnings justify a higher price. When it got really cheap here, kind of in the throes of COVID, that was a great time, to be buying the stock. And then the last stock I'm going to cover as a value stock is another one that is arguable. Okay, and it kind of has some nuances of being maybe a cross between a value investment and a value trap, okay? And I've owned this stock for several years because as I looked at IBM, IBM was going through a transition. You can see they had a great growth record here for many years. Now, they were way overvalued coming into the recession of '01. Then they became attractively valued, and performance from this first time where you could have bought it at an attractive valuation, if you will, if I can hit it here, would have given you several years of really excellent double-digit 13 to 14% performance, okay? And then, of course, the cloud came about. IBM was going from a transition to their big servers and so on and so forth, and the company's fundamentals have really been weakening for several years. But all during that time, my argument is that the profits of the business still stayed profitable, even at its worst. Coming into COVID, the stock price, that's the first time the stock price really made any sense, if you will, even though it was lower than what it was back in the years. But now we're starting to get a recovery. So is this a value trap or a value stock? And my argument would be because the company has continued to raise its dividend each and every year, and it was primarily purchased by yours truly for the income it produced and the quality of the company. It's an A- rated company. It's IBM, for goodness sake, has very strong financials. And, the company has done things like buy stock back, but it's been okay because the stock has been real cheap. But when I'm looking at it from a dividend perspective, purely, the cash flows per share and again, they've been buying back shares to partly accomplish that, but that's okay because as a shareholder, I'm getting a bigger percentage of the company every time that my stocks represent a bigger percentage of the company every time they buy back the stock. And I've never been in any fear of IBM cutting their dividend. And so far, so good. They haven't cut their dividend. So I wasn't just looking at this stock to make money. I plan to own IBM for a long period of time, as long as their cash flows and their free cash flows, and this simply means there's no estimates for free cash flow going forward, you can see their free cash flow significantly covering their dividend. Their dividend payout ratio of free cash flow has been around 40%. And that's, excellent. The company has continued to generate, not rapidly growing, but strong free cash flow covering the dividend. So I still consider this one a value stock, not a value trap. And that's the big distinction that I think investors have to make. You have to recognize a value trap is when you're looking at companies whose fundamentals are collapsing. Pitney Bowes is probably the classic example. Pretty good company all along. It always was. Now it has massive amounts of debt and is trying to figure out a way to, take their resources and make money. But in the meantime, their fundamentals have continued to collapse and their dividend has collapsed as long. In contrast, when you look at stocks, that are true value stocks, their fundamentals have continued to perform well. Even when you had something like, this again was not management's problem, what you saw with Brinker's, the company is now back to doing what they normally did. This was beyond management's control. A good company that just ran into a maelstrom, if you will. Value investing works. But one thing, again, that I want to close with is that you've got to recognize as a value investor, when you're investing in these stocks, when they're out of favor, okay, this would have been a great time to buy Cigna, for example, right here. But that didn't mean that the stock didn't drop further after you bought it. And it didn't mean that it wasn't still going to be lower even a year or two later before it starts to recover. I always say in value investors have to have intelligent patience. You got to continue to trust the orange line on the graph or the dividend lines on the graph more than you do the stock price, because the stock price lies. Where if you're buying good businesses at good valuations, eventually you're going to do extremely well. And, probably, maybe the best example of that would be Cigna, whose long-term performance has been absolutely stellar And, there were times when you could buy the stock when it was undervalued, overvalued, et cetera, but it's always performed as a business, and therefore the stock has always performed with it. Anyway, this has been Chuck Carmel saying, hope you got some insight into the difference between a value trap versus a value stock. Again, a pet peeve of mine. I really hate it when people automatically just look at the stock price and say this is a value trap. Now, sometimes, it is a trap for a year or two, meaning that the price didn't work. But if you stick with good value stocks over the long run, you'll do extremely well, and you'll be doing it at reduced levels of risk all along the way. Thanks for watching. Hope you enjoyed the video. Give me a like, thumbs up, ring the bell, subscribe to the channel if you haven't already for more like this. This has been another one of my subscriber request Tuesday videos. Look forward to talking to you guys again real soon. Thanks for watching.